Okay. Please do let me know if my voice is audible to everyone. If it's audible, you can just quickly let me know on the chat box. Please do let me know if my voice is audible to everyone. All right. So I think I was speaking to no one with my mic on mute. Anyways, so before we get started, yeah, okay, hi, great. So Santosh can hear me, Mohammed can hear me, wonderful. So, if you guys have not attended my last few live streams, uh, nothing to worry about. But the previous two streams were about interview preparation for investment banking and finance jobs, right? We at Mentor Me Careers work. We run an institute which works on finance placements, and we teach courses like financial modeling and CFA level one. I myself am a CFA charter holder with about 12 to 15 years. 12 years of experience, partly into business, partly into fund management, and an avid investor. I love businesses. I love to analyze businesses and understand them and give insights on them. And more bigger passion than that is actually to teach and mentor people. All right, that's what I enjoy personally. So, and that's why Mentor Me started, because it's although the name does not suggest that we actually teach some courses, but the word mentoring is very, very close to me, because uh, if I have achieved something in my life, whatever little things I have achieved, the clarity I've achieved is because of a lot of mentors that I found on the way. And it's always good to give it back to someone who needs mentoring. And that's the reason Mentor Me started, right? And we are a team of about 12 to 15 people doing various functions, but most importantly, teaching people, right? More than the business. Uh, in fact, to tell you the reality, I did not start this business to make money. It might sound like a cliche, but uh, that's the fact, because being a CFA charter holder myself, I took care of the wealth before I started this business. And this business was started for the sole purpose of making students capable to clear interviews in finance jobs. That's a big problem, you know. As small as this might sound, the current, awareness and capability of skills of students uh, is a little low. Okay, believe it or not, it is a little bit of a problem. And be it MBA colleges, be it CA candidates, be it BCom candidates, be it CFA, it doesn't matter. So there's a big gap between what we know theoretically versus what gets actually tested in the interview, right? And the way education system is finally moving forward, I don't see in another 5 to 6 years uh, degrees importance increasing. I'm not saying decreasing, but definitely degrees importance might not increase, but skills importance is going to definitely increase. And that is very, very evident with the interviews. If you look at the interviews, what is finally happening, no matter what degree you come from, you have to go and give the test, right? And that's why we started Mentor Me, focusing entirely on teaching what finally gets tested in the interview, right? And one of those cases is what I'm going to cover today. So I hope you have the access to the template, guys. If you do not have, just go to the description box. There's an open Google Drive folder in which there are two files. One is the case document, which explains what we are going to evaluate. And attached with that is basically a template, an Excel template, which is exactly what you see out here. All right. So once you have the file, we can start quickly, right? So I've taken a very simple example of evaluating a Wellness Forever franchise. All right. And there are some details which are given in the PDF file, which you'll see about the business, but most of the details I've actually given here. And what we're going to do is we're going to create a simple financial model, and we're going to try to find out whether this business makes sense from a return perspective or not. Believe it or not, capital finally finds way to the most efficient asset. Okay, you have to understand this well. And it's you and me who finally decide whether the capital is going to go into bonds, whether it's going to go into an IPO, whether it's going to go in a business, wherever, right? And that is based on evaluation of businesses. So if the returns are attractive, the capital will go into this business. If the returns are not attractive, the business will not, the money will not flow into this business, right? So if you can see the document, you will see that this business has details about the business are given as there are two kinds of drugs that the business sells, right? Drug A and drug B. And drug A is a low budget drug, right? It gives us a contribution about 35 rupees, right? And drug B is a more expensive drug, which gives us a contribution about 65. Contribution means nothing but the amount of money that we finally get in this business by operating this business, right? And below you can see out here drug A and drug B volume. So how much volume do we get? How much volume do we sell finally, right? So you can see that the low budget drug sells more. So that's about 250 odd units that we sell per day. And drug B is about 200, right? And all of these values finally, including the money that we get, include the volume that we get, increases year on year by 5%. Okay. So the increment year on year is 5%. And we're going to start the business in 2021. That means we're going to set up the business in 2021, but the operations is going to start from 2022, right? And the business, we will try to evaluate the business thinking that we will exit the business in 2026, right? And try to find out how much returns did we make. Please do let me know in the chat box if I made sense, okay? Or did it all go bouncer? If it made sense, quickly tell me in the chat box that it made sense. You're good to go, and we will start further. Okay, so Amir did not understand. Okay, so I'll try to quickly give you a recap. Okay, so this business is think of this business as a simple business of a medical shop that we're starting. It is for a brand named as Wellness Forever. It's very famous in Maharashtra. Okay, and we're basically selling two kinds of drugs in this business, two kinds of products that we're selling. And each of this is going to give us 35 and 65 rupees per unit as commissions to us. So for us in a franchisee business, the commission is the revenue, right? So that's what we're getting here, 35 and 65, right? And below here, the volume that we're going to sell per day on these are 250 and 200 respectively, right? And we're going to calculate the revenue for the future. Okay. We're going to calculate the expenses, the profit, everything. And then we're going to finally do a return calculation. So don't worry too much. Just follow along and you will actually get what I'm trying to do out here. Okay. Otherwise, Santosh and all the rest of you, I hope it's making sense. Is it making sense? I'm sorry, I'm not able to see everybody's name out here in the chat box. So I might not be able to call out your names, but just do give me a thumbs up in the chat box if you are with me. Wonderful. So let's start by starting our model. Okay. So always remember, in a financial model, you do not start calculating the revenue in the first column itself. You want to make sure that the revenue matrix, okay, these are your revenue drivers finally, right? What is the product that you're selling has to be kept separately. So if you see, we have kept it in row number 3 to row number 10. So that's where we are keeping all the revenue product calculations. All right. So let's populate this now. So from 2022 onwards, we're going to just link it to 35. So that's the price that we're going to get for drug A that we're going to sell. Okay. And that increases by 5%. So the way to put up the formula, and also zoom in a little bit so that you can see better, is equal to, and we're just going to increase the value, right? So last year's value into, so shift and 8 will give you that star mark, which is basically multiplication in Excel. Open the bracket, shift and 9, 1 plus, okay? And you can either use your cursor to go and select 5%, or you could just use your cursor, your arrow keys to go to the left and select that 5%. And now here is where you can use Excel for your benefit by making sure that you do not just directly link the complete dollar sign. This is the dollar sign for absolute referencing, so that it does not change. This 5% is fixed. But we're going to use a column dollar sign instead, which is done by pressing F4 twice. F4. Okay, F4 is the shortcut key for getting the absolute referencing, which is nothing but these dollar signs out here. All right. And I close this. I'll tell you the benefit of doing this is that I don't really have to keep on replicating this formula again and again. Okay, so this, when we will drop this formula down, it will auto calculate even for the other cells. All right. So there you go, 37, and copy this and drag this to the right. So now we have prices across years, right? For drug A, right? Clearly can see the prices for drug A and across all years. And now we're going to replicate this below, okay, to drug B, right? And since we put the dollar signs correctly, right, we're going to copy this. And if you see, it correctly comes to the next 5% and paste it to the right, and it will replicate exactly how it's supposed to, right? So now we have the commission per unit prices populated, and we're going to replicate this now, the same structure for units sold. So this is what I meant, that make sure that the price and quantity values are calculated separately in a financial model. Because if you try to mix it up in just the income statement, later on, if you want to change values, it'll become very confusing. Let's say some investor comes and says that, no, maybe the volume will increase by 7%. So in that case, you will not be able to do the adjustment. So that's the reason why we're doing this. All right. Now let's try to do the same for the unit sold. So I link 250 out here, right? Just linking it, link below 200. And now, in fact, we can just copy the same formula out here and it will work, right? So using appropriate absolute referencing really does help us in saving a lot of time, you see? So that's the reason why finance finally requires a little bit of Excel knowledge, not much, but good enough knowledge, so that you are able to quickly and be very agile with using such shortcuts. All right, it's not a big deal, trust me. With practice, it does come. Now we want to calculate sales. Now this is where we want to calculate what is the final money that we make annually. All right. So now again, there's a tendency for people to do this calculation manually by multiplying 35 with 250, then plus. Okay, now this can be done, but it takes a lot of time, right? And it can create mistakes if you do not use brackets properly. So what we're going to do is we're going to use sum product function. Okay, it's going to do exactly the same thing, but it's just plain simple, very easy to use. So sum product array 1. Okay, so it's going to do exactly the same thing which we were trying to do manually, comma, array 2, and just multiply it with 360 and press F4 to fix the referencing. Just press F4 to fix the referencing. All right. So it did exactly the same thing manually. The only thing is there's very less chance of any mistake happening here. Okay. And the thing with any financial model is that unlike a software, it's very difficult to find out the mistake. So there are some basic principles that you follow while making a financial model, which avoids you to make any mistake, make any major mistake, right? So there you go. We copy this formula across and we have with us the revenue or the sales figure with us, right? Please do let me know in the chat box if you have the sales value with me and if it matches with mine. Okay. And if anybody has any queries, please do make sure to put it in the chat box. Are we good? Can we begin calculating other expenses? Do make sure to let me know whether the number matches. All right. So now we go into rent expenses. Okay. So again, while you try to evaluate and see what we're calculating, and generally people when they make financial model, they become very, very short-sighted with just doing the calculation. But the larger objective of any financial model is to get the assumptions. So even if you are starting a business, right, you want to make sure that you spend more time getting these assumptions right. Mohammed Amir, you need to go to your Excel and click on enable editing. Okay, you will see when you open the Excel for the first time, it will ask you on the top, just click on enable editing and you should be able to edit. All right. So rent expenses out here is given is 750 is the area, the square feet, and 100 rupees per square feet per month is the rate. All right. And you can see out here, the assumption is given per square feet per month. So if I multiply these two, okay, and multiply it with 12, then that gives me the entire annual rent expenses, right? Now, we do not have any assumptions stating that my rent expenses are going to escalate or increase. So there are two ways to fix this up. Either we can go between these cells and press F4 to fix the absolute referencing, or the easier way to do was to just go to the next cell and type is equal to last year. Okay. So if you did is equal to last year, it would have fixed anyways and pasted across. So that's your rent expense out there. Right. That's your rent expense. Now we go into salaries. Now again, salaries is given as per month expenses. All right. I'm going to multiply that with 12. Okay. And we're going to fix it again is equal to last year for all the periods. So there you go. That's your salary. All right. Now, frequently you will see in a financial model, you cannot get assumptions for everything. For example, it's very difficult to find out assumptions on how much my electricity bill is going to be, how much water I'm going to consume, how much coffee I'm going to store for my employees. So general thing that you do is take other operating expenses as a percentage specific to an industry. Okay. So if you're in a specific industry, you will be able to find out what the other operating expenses, which includes everything, right? Any staff benefits that you have, electricity bill, internet expenses as a percentage of revenue, right? So out here we have assumed as 20%. So I'm going to link 20% and multiply it with the sales. So this is value is given as a percentage of sales. All right. So link it and press enter, and you should be able to get the other operating expenses as well. There you go. Okay. Moving on. Interest expense. Now, interest expense, it's very difficult to calculate right now because we need to first calculate what's the investment, right? Now, for investments, I would suggest you to open up the PDF. Okay. The PDF will actually tell you what the investment is going to be about. Okay. So if you open the PDF, you'll see that the initial investment includes a one-time renovation of the premises of 20 lakhs, all right, and the deposit of 10 lakh. Okay, so these are my two initial investment. Now these are never considered as a part of an income statement because it's an investment, it's an asset, so you generally tend to depreciate it because you cannot really say that the renovation that you did is just for 1 year. So if you said that the renovation you did is for 1 year, then you could put the entire expense on the income statement. But if any expense or asset is created for multiple years, you tend to depreciate it, or in other words, all you try to do is try to divide it across years to make sure that the income statement actually shows you the real picture. All right. So out here we can see that our initial investment is the deposit of 10 lakhs and the one-time renovation of about 20 lakhs, right? So we can go back to our Excel and put these values there. So our deposit is 10 lakhs. I'm going to put it here, right? I'm going to slightly increase the column out here, column size out here, 10 lakhs. And the renovation is 20 lakhs. So this is our initial investment. So which is about 30 lakhs. Sum it up. Okay. So our total investment is 30 lakhs, out of which 50% is going to be debt. And of course, if 50% is debt, then the rest of the money is going to come from equity, which means our pocket, right? So we're going to put this formula here, 1 minus 50, to make sure that later on, if we change that debt percentage to 40, then automatically this value will change to 60, right? So that's my slight adjustment. At any time, if you've missed a calculation, make sure that you can just go back, replay, and come back live again in case you are having trouble with the calculation. Okay. So now debt, multiply the total investment with, and make sure to put the correct absolute referencing and link it with the debt percentage. All right. And drag it down. So now our debt and equity calculations are, amount is ready, right? Now we wanted to make the model a little more simpler. So we do not create a debt schedule out here, because for that I'll have to teach you time value of money, which unfortunately is not possible in 1 hour. So we've selected a bullet structure of debt payment. So we're going to pay interest every year on the same amount, and at the end we will repay the entire debt. All right. So which brings us to interest calculation, which is 10% multiplied by the debt amount. Okay. So that's about 1,50,000 of interest that we're going to pay across years. There you go. All right. And once we have the interest, we can quickly calculate the profit before tax, which is sales minus all the possible expenses. All right. So PBT, profit before tax, is sales minus sum of all the expenses. There you go. All right. Copy this across to the right. And we have our profit before tax. All right. Now we're going to just quickly calculate tax, and then we should have our profit after tax. Now, we have not considered any of our transactions to be credit or accrual. What I mean by accrual is that not everything tends to happen in cash in every business, right? But to make this model simpler, we are not creating a balance sheet and cash flow, right? Hence, we are considering that everything that is happening out here is on cash basis. That means there is no credit sale. All right. So in tax, we will put an if function to make sure that if there was a loss, there is no taxation which is getting calculated, right? So we're going to put a logical operator here. So if the profit before tax is greater than 0, only then will the tax get calculated. All right. So that would be if the profit before tax is greater than 0, then profit before tax multiplied by the tax rate will give us the tax value if it's positive, right? Comma, If there is no profit, that means if it's a negative taxation, I mean negative profit, then there should be no tax getting calculated. So the tax will be 0. It's a simple logical operator. I mean, this is again one of the functions which you should know in finance, because a lot of times in finance specifically, we deal with positive and negative numbers, and this tends to help, right? So there you go. So taxation is calculated. And finally, PAT, which is PBT minus tax. So considering that everything is finally cash, that means this PAT value is also finally cash, right? And using this value, now we will actually do the return calculations, all right? So I hope you are at speed with me till here. Now, this is where it's the most interesting part, right? Because this is where it's the decision-making part, right? All of this is finance. I mean, you have to know financial statements for it. But here is where, I mean, either it's a positive return, either we're going to select this business or we're not going to select this business, right? So we're going to start putting values. Okay. So 2021 is when we invested the 30 lakhs, right? So we're going to put is equal to minus and select the total investment of 30 lakhs. So this is the final cash flow calculation, which is also known in finance as a free cash flow calculation. Okay. So we're basically doing a free cash flow calculation. But if I don't name that as free cash flow, then it actually tends to go into our brains very quickly. If we start taking technical names to everything, then it becomes a little complicated, right? And finance is majorly just logic. So all we're trying to do out here is saying that, okay, how much total money did we put in the business, including debt and including equity? So we put in 30 lakhs, right? And since the money went out of our bank account, that means it has to be negative because it's an outflow. So I put in the negative sign and I selected that 30 lakhs, right? However, having said that, not the entire 30 lakhs was my own money. I also borrowed a lot of money, right? So, and when I took loan, the money came into my bank account, and hence it's a positive inflow of 15 lakhs, right? So I got the 15 lakhs as an inflow, right? Now, that's for the first year, right? And nothing else happened in the first year. Now what we're going to do is the business cash flows is what we're going to link in the calculation from here. So every year, this value will get populated for the final cash flow that the business is generating, right? So we linked the PAT values out here, right? There you go. And then we just sum it up. So you can see that the value comes out to be as negative 15 lakh, which is nothing but stating that you actually invested 15 lakhs equity, right? So you invested 15 lakhs equity, and on your equity is where we are interested in calculating how much return did we make. We are not really interested in understanding how much money did we make on a 30 lakhs, because 30 lakhs also includes debt. So finally, the cash flow that we're trying to calculate out here is nothing but free cash flow to equity. If we did not do this adjustment out here of 15 lakhs, then this would have been called as free cash flow to firm. All right. So anyways, so let's copy this and paste it across to year 2026. But hold on, we still cannot calculate the returns unless, okay, I'm so sorry about this. Yeah. We still can't calculate the returns because we still have to exit the business in 2026, which would mean that our deposit would come back. Okay, so you can see out here that we should have a positive cash inflow of the deposit because we will exit the business, we will exit the property, and hence the deposit that we gave the landowner initially should come inside my bank account. So it will be a positive of 10 lakhs, right? Plus we have to repay the debt, remember? So we're just going to take a negative value of that 15 lakh that we raised initially. There you go. So this is how the cash flow is going to look, right? So if I just summarize quickly, 30 lakhs total investment, 15 lakhs debt was raised. So total equity invested is 15 lakhs negative. These are all your PAT numbers below. Debt gets repaid at the end, negative 15 lakhs. deposit comes back to you, so 10 lakhs is positive, and this is the summation of all the cash flows. So finally, what you are getting on row number 34 is nothing but the final cash flow after paying off everything, right? So this is the time when we calculate finally the returns, right? Now I'm interested in understanding how much returns that we make. Now in this case, this is a usual case of an uneven cash flow. What do I mean by uneven cash flow? Uneven means that every year the cash flow is not same, right? It's fluctuating up and down, right? So you can't really calculate returns manually by stating that, okay, I invested 15 lakhs and I got this much cash flow, because cash flow is coming on different years. So in that cases, we use something called as the internal rate of return. I would have loved the opportunity to explain you IRR in a lot of depth, maybe in a different live session if you request such session, that you want me to discuss this on how to calculate IRR manually, then I would have done that session. But in this session, I'm just giving you a shortcut stating that in case of uneven cash flows, for return calculation, we use something called as the internal rate of return. Okay. So we use IRR, open the brackets, okay, and select the cash flow from 15 lakhs on 2021, okay, all the way up to 2026. There you go. Okay. Bumper return 197. Okay. So what it states is that if we run this business, we will be able to generate a CAGR, a compounded annual growth rate of about 197. But do not get too excited about IRR returns. Okay. And I'll give you a very simple example to probably which will make sense to you. Okay. IRR usually will be very high in businesses which do not require that much capital investments. Think about this. Okay. So if you wanted to start, let's say, a business which does not require any investment, if your initial value is very low, like in this case, it is 15 lakhs, right? And the profits are very high, I mean, comparably very high, then your returns are bound to be higher, right? But that does not mean that this business is the best business, because finally, can you scale this business probably 200 times? Probably not, right? Because business scalability is also an issue, right? So, for example, a manufacturing business might give you a lower IRR, maybe about 15 to 20% returns, but it can generate a lot of capital, right? Out here, all you're talking about is 27 lakhs, 65,100, 31 lakhs, 36 lakhs. But can this handle 300 crores? Probably not, right? So that's why you have to be very, very careful with IRR. So IRR is all it's saying is relative to your investment, how much money are you making? That's why there's a nice concept called as the NPV. Okay. So NPV is nothing but net present value. So now this removes the factor of percentage return calculation, and it directly tells you at a net level, considering the cost of capital, what is the capital cost that you have, how much money did you make, right? So let's say our cost of capital, okay, cost of equity, which means nothing but the 15 lakhs that we invested initially, what is the cost of it? Every money has its cost. We tend to think that our money does not have a cost. Of course, it has a cost. If I had not invested in this business, I might have invested in a large cap equity mutual fund, which would have given me 15% return. So the cost of equity for me is 15%. Okay. Now I can calculate NPV. Okay. So to calculate NPV manually, I'll show you both ways, manually and using a formula. But for that, we just need to do one simple adjustment, is to make a row of year. Okay. I'm going to put it year 0, 1, 2, 3, 4, and 5. All right. And we're going to use a very simple formula of calculating present value, which is nothing but the value of cash flow divided by 1 plus the cost of equity, close the bracket, raised to the number of years. Now, this, if you have done MBA, CA, or CFA, whatever, every, or even BCom for that matter, every syllabus has this formula of present value and future value, right? And all we're trying to do is we're trying to get all these values, cash flows that we're getting in the future, back to today, because we are interested in evaluating the business today, right? So we're getting it back and trying to assess finally how much money did we make, right? So 15 lakhs is obviously going to be 15 lakhs, but because we're talking about first year, which, I mean, 0th year. So 15 lakhs today is 15 lakhs finally, right? But 27 lakhs 65,000 next year probably is not 26 lakhs 65,100 today. So what is it? So based on 15% cost of equity, the value today is 24 lakhs. The value of 31 lakhs today is going to be 24 lakhs, right? And so on. So you're getting the idea of what we're trying to do. We're just trying to get all these values back to today, present, and then just sum it up to calculate what is the net present value. Okay. So now this removes the percentage problem of giving us this humongous return and showing us how much money did we actually make. And you can clearly see how much money we made, right? So it removes that factor. And if you want to see in crores, so we may, I mean, by running this business for about 5 years, at a net level, we make about 1 crore. Now that gives you a perspective, okay, how much is this business worth also from the scale of money, right? Because you really don't care just about the percentage returns. You also care about the scale of money, right? And this tells you the scale of money, which is nothing but 1.02 crores, right? So now, based on this, of course, in an IRR level, right, 197 looks fantastic, right? But at a at a level of money or the scale of money, we're making 1.02 crores. Now, that is what you need to think, that by investing this time of, let's say, 5 years, does 1 crore sound interesting to you? Okay. If it sounds interesting to you, go ahead, start the business, right? But if you think that 15 lakhs and then just 5 years doing so much in the business and then 1 crore is not making sense, maybe you need to look at some other businesses and try to calculate the same returns and see which one of these are better. And always remember that the decision has to be made mostly on NPV, higher NPV, not higher IRR. Okay. Always make decisions on higher NPV, not on higher IRR. Okay. And now, since we are running out of time, I'm just going to quickly show you how to do sensitivity analysis. Okay. Now, obviously, all these values are assumptions, and every business owner is worried that these assumptions might not turn out to be the way it is, right? So that's where we use something called as sensitivity analysis. And what we're going to do is basically test these assumptions. So the first assumption that we can test is the interest rate. Interest rate versus, let's say debt versus equity, simple, right? How much NPV would have made by varying the amount of debt that we raised, right? So if you see, our original assumption is about 50% debt, right? So what we can do is we can create different scenarios of debt. So if we had, let's say, taken 60% debt, 50% debt, all the way up to, let's say, 90% debt, right? And also maybe 100% debt. Highly unlikely. But in fact, it's not highly unlikely. There are a lot of businesses which can start with 100% debt also. Maybe in a different live stream, I'll talk about that. All right. And a similar structure for equity. Okay. So 50% equity all the way up to 100% equity. Let's see what happens. Oops. So 50-50, this will be 60-40, 70-30, 80-20. In fact, actually, you know what? We should create from 100 all the way back. Okay, so on the left hand side, what I've done is I've created a equity, how much equity percentage we're going to take. Okay, and I'm going to just change the orientation of that text. Right, so that's equity percentage. And out here, we've got debt percentage. Okay, debt percentage. And I'm just going to label it quickly so that you can clearly identify what's happening here. So that's the amount of debt. There you go. Okay. So let me just quickly check whether the values are matching. 6 values out here. Okay, makes sense. All right. And now what we're going to do is, this is where Excel is going to do a lot of work for us. It is actually going to replicate the entire calculation for us in a click of a button. Okay, imagine doing the entire NPV calculation again and again in all of these assumptions, right? So that's the beauty of Excel. All we need to do is, once we've created this, we're going to link the NPV calculations out here. Okay, so we're basically telling Excel that replicate this NPV out here in these various scenarios. All right, so I'm going to just select the entire table and make sure that you're selecting it exactly the way I've done it. Okay, and the exact way is to make sure that the assumptions are to the corner. Go to data, go to what if analysis and data table. So that's your data table. Now, all it's asking is, Excel is asking you, what do you want? I mean, what is these? I mean, Excel does not understand what is 50-60 on the horizontal line and what is 190 on the vertical line. So we got to just make sure that Excel understands that, right? So how are we going to make it understand? So row input, very easy way to understand what is row and what is column is to just check the direction of the data. So if you look at the direction of the data, you'll see that on the direction of the row, we've got our debt percentage, right? So we're going to go to our original assumptions and we're going to select debt. So what we're trying to tell Excel is that these numbers out here, 50, 60, 70, 80, 90, 100, is nothing but debt percentage. All right. So it's going to use that in the calculation. All right. And similarly, column input, we're going to basically tell Excel where these values are in the original calculation. So, okay, we're going to go up and select equity out there. All right. So what we mean to say is these values out here is nothing but equity percentage in the original calculation. And then that's okay. Right. Now, this is where I want you to notice something. Okay. If you see out here, and this is usually the problem with a lot of candidates when they do this calculation, is they will not use cell referencing in the original calculation. Okay. Now you can see that the values are coming exactly the same for, and probably it will come same because 50 and 90 does not make sense. But if you see out here, okay, you will have to actually see the relevant positions. So 50 and 50, it gives you about 1017, which is exactly what you got here, right? But in other cases, you'll see that we really don't have 60-40 calculation, right? I mean, where's the 60-40 calculation? You can't really see 60-40, right? So that brings us to the case that probably what we need to do is we will just write here 40%, right? And you should be able to get 60 and 40 scenario here. Then 70 and 30 is perfect. 80 and 20 is perfect. 90 and 10 is perfect. 100 and 0 is also perfect, right? Now, we're going to quickly go and check whether our referencing has been correct. All right. So the way to check your referencing is to see wherever the debt calculation was there, was everything linked? Okay. So out here, let's see, 30 lakhs, it's linked, right? So it's linked from here, right? But if you see this 30 lakhs, now see the problem here, this 30 lakhs is not coming from here, right? So the better way to actually link this is to link it from the debt and equity calculation rather than linking it from above, because this is a hard coded number. You see, these are manually put, right? So it's best to link it from here, right? Now let's see the debt value. So debt values are linked properly. This is also linked properly, right? Total cash flow is fine. Let's look at the interest calculation. Interest calculation is also fine, right? And now you see the values are changing, right? You can clearly see the values are changing in every period. Now there might be still places where the linkages might have happened incorrectly, but mostly it looks fine, right? Yeah, this is fine, this is fine, this is fine. Okay, now let's try to interpret. So if you have let's say, if you're talking about, let's say, 70 percent debt and 30% equity, you can see out here this is your NPV, right? So you're going to make slightly more because you are taking more debt, right? If you take 80 and 20, you'll see again that you make even more, because the larger money that you're borrowing, the lesser you have to put your own money, and hence more money is left. And that is why you have a higher NPV, right? If you take 90% debt, you even have higher values. See? And as you keep on, and if you take 100%, then there's jumbo, right? It's about 1059. If you take 60 and 40, right, you have about 102. And if let's say I create 50% here, okay, just to show you what the original is. This is what our original value was. Remember, it was 50% debt and 50% equity, and it is matching with this value. But what if I had taken lesser debt? Okay, let's say I created a scenario of 40% debt and 60% equity. See how the values are dropping, right? So you're generating lesser money. Let's create 30 and 70. So you will see you're making even lesser. Let's say if you are going 100% equity, then you make about 9743806. So this sensitivity can not just be done on debt versus equity, but it can be done on multiple scenarios. It can also be done on these revenue growth, product price, expenses, taxation, name it. And this is nothing but called as sensitivity analysis, and it is likewise used even for equity valuation. Okay, we did a case of a business proposal, but the concept is not different even in equity valuation. All right, so that's the end of the long class. Okay, I don't know how much of that really made sense to you. Okay, because I've skipped all the theory in between, which we usually teach in the class, and then I've directly taught you how to although the model is not very difficult. I mean, I hopefully you got the idea of what evaluating or use of a business model is, right? So if you have any questions, please put it on the chat box. Please do let me know if you like the session, if you dislike the session, if you have any feedback for the session. I am happy and listening and open for views, right? Or also please do tell me what you want me to cover in the next class next week, because believe it or not, I run out of ideas, right? So please do let me in the chat box what you want me to finally cover in the next session, so accordingly I prepare, right? Yes, Santosh, did you like the session? Did you not like the session? Please do let me know. Okay, so if no questions are there, please do feel free to put it in the comment box later when you have watched the video properly. I'm sure a lot of people must be just still trying to get hold of the calculation, because I might have been a little fast. Uh, I'm sorry, but because it's a little difficult to go very slow, because uh, at the end it's a live stream, right? But if you have any questions related to this calculation, I am happy to answer that even later. And feel free to connect me again in the next stream. And also, please do let me know what you want to learn in the next class. Accordingly, I will be presenting the session. All right. So thank you guys for joining us in the session. My name is Alan, and I'll be signing off now. And I hope you have a nice week. And I'll see you again next week. Bye bye.